Yeah, I think let's kick off. So again, thanks everyone for joining us today. This is the second webinar out of the six-part series, the Complete Tech M&A Playbook. Don't worry if you missed the first session yesterday. The way they've been designed is modular, and we'll share those links and we'll share those PDFs with you afterwards also. These webinars are designed for founder-led technology companies that are considering an exit, a partial sale, or future liquidity event. We talked yesterday about, we kicked off by saying how we got a multi-billion-dollar NASDAQ listed company interested in a European tech company, privately owned, that's doing a few million in revenue, and how we progressed them from what was initially the lowest bid to the winning bid. Founder walked away with 80% of the cash up front. Nothing changed about the company. There weren't any new clients. What changed was how we positioned the business and how we ran that process. So we're going to talk a lot about buyer psychology today, how to engage with buyers, how to prepare the business, how to shape that narrative and control the positioning before you enter any serious buyer conversation. And the reason that matters in M&A is very simple. Buyers underwrite risk around the quality of the process, around the business. So a strong company can still be discounted if the story is unclear, if the data is messy, or the founder seems uncertain about what they want. So on that note, let's kick off. My name is Idi Youssef. I'm a director at Venero. I've joined the company at the turn of the year. Before that, I was with another investment bank focused on founder-led tech companies. And before that, I was a founder myself with 2 exits. So I bring a slightly different perspective in terms of that operator angle, as well as the corporate finance experience. And now enjoy spending my time working with Georgios and the team to help founders navigate through the M&A process. Georgios, over to you.
Yeah, thanks, Ili, and welcome everyone. It's great to have you here. Me personally, I enjoy sharing lessons learned and tips. There's just so much to share, and yeah, we broke this into a session of 6 webinars, some more high level, some drill down into more detail. Obviously, we can't cover absolutely everything, but on every session, we try to share as much useful and relevant information per topic as we can fit in the hour. So yeah, please make this. Feel free to make this interactive, ask questions, and we'll address them. From past webinars, I think people have enjoyed actually asking specific questions and getting the answers to those. So please don't be shy. For those of you who don't know Venero and myself, so we'll talk about Venero in a bit, but my background briefly. So I've been with Venero now for almost 10 years. Before that, I was at Deutsche Bank and Morgan Stanley doing M&A across EMEA. Worked on transactions from hundreds of millions and billions over there, and then for the last 10 years with Venero, we focused on mid and lower market transactions. And yeah, excited to share some of the insights with you guys today. Maybe I'll keep going. So a bit about Venero for those of you who don't know us. So we're an investment bank focusing primarily on sell-side M&A advisory. So we work with founders to help them get great exits. That's about 70+% of what we do. And then we also support companies with equity financing advisory and also debt financing advisory. What is different in our case is our deal teams are what we call partner-led. So our senior bankers see the transaction through from beginning to end. So we work with our clients hand to hand. The senior banker leading the deal doesn't hand it off to a junior for the execution. And then second element is we have a very international coverage. Our buyer network spans, all the major markets: Europe, North America, South America, Australasia, Southeast Asia. So all the major geographies we cover very, very well, and of course the market insights that we bring, particularly in some sectors more than others as well, by the way. But we bring that deep market insight that also helps get great outcomes for our founders. The rest of our team, again, you may have met some of the folks here if you've joined some of our live, in-person events. Ili here is a former operator helping founders exit. The rest of the senior bankers are either ex-bulge bracket investment bankers from HSBC, JP Morgan, Rothschild, Crédit Agricole, or operators like Ili who have worked in their specific sectors in the past. They've done their exits, and now they're supporting founders, leveraging their experience to get great outcomes for those founders as well. And then in terms of our geographical coverage on the next slide, again, as I mentioned, we run mandates globally, so from Australia and Southeast Asia to across Europe, North, South America, so very international, with local presence in some of the major cities worldwide. And then the next slide, some of our indicative transactions, again, across segments, across size, across geographies. I mentioned maybe more than almost 80% of the deals that we worked on have been cross-border. So the buyer has not been in the same geography as the seller. And that's quite telling. A lot of the times we find that markets from out of market tend to actually pay a premium to those in-market buyers. So yeah, that's another angle that is worth exploring, and we'll touch on this again today as we focus on buyer management. Ili, over to you.
Thanks, Georgios. So today's webinar revolves around one question: how do you get buyers to see your business the way that you want them to see it? Most founders assume that if they've built a good company, buyers will naturally recognize its value. In our experience, that's rarely how it works. Buyers don't see your business the way you do. They see it through the lens of risk, return, and strategic fit. Your job is to help them understand why this business deserves their attention and why it's worth competing for. So in this webinar, over the next 35 minutes, we'll walk you through the 4 steps we believe make the biggest difference. We'll start by looking at what buyers actually need to believe before they're prepared to engage seriously. From there, we'll look at how to build a narrative that connects with both strategic and financial buyers. We'll then discuss the preparation that needs to happen before the business goes to market. Because once buyers are involved, it's already too late to be debating objectives or trying to fix the basics. And finally, we'll look at the common mistakes that quietly we can leverage before the first offer even arrives. And then we'll wrap it up with a practical case study showing how we develop an institutional-grade information memorandum and why it's one of the most important documents of the entire process. All right, so with that context, let's move into today's topic: how buyers engage, how they evaluate opportunities, how founders can position themselves more effectively before even entering the market. So as I like to do, we'll start off with a misconception. One of the biggest misconceptions founders have is that buyers are looking for perfect businesses, and that's really not the case. Most companies have issues somewhere. Even really well-performing companies do. What buyers are really assessing is whether they can get comfortable with those issues. They need to believe that the business is robust, growth can continue, risks are understood, and the upside justifies the investment. Almost every diligence question you receive is trying to, build confidence in one of these 4 areas. And you have to remember, the person sitting across from the table is usually selling the acquisition internally as well. It might be to their investment committee, it might be to the board or the CEO, but they're putting their credibility on the line every time they recommend the deal. So they're on the hook as well. And the questions they're asking is, look, is the business robust? Credibility can be surprisingly fragile. If buyers stop trusting one number and then they start questioning all of the numbers, that's why consistency across your financials and your KPIs and forecasts is important. They're going to ask, is growth repeatable? One comment we hear is, this is, we've achieved this with a lean sales team. Founders usually see that as strength. Buyers often see that as founder dependency, for example. The better story in those situations is that you've proven product market fit, and there's a clear opportunity to further enhance or professionalize the go-to-market and scale from there. And third is every business has risks. Buyers aren't expecting you to eliminate them. They want to know that you understand them, you've been transparent about them, forward about them, and you've got a credible plan to manage them. And finally, they want to know if the upside is worth paying for. Forecasts are another area where credibility can disappear very, very quickly. You have to keep in mind that buyers have seen thousands of business plans. They know what an ambitious forecast looks like. They know what a credible one looks like. If the assumptions can't be defended, then the numbers quickly become irrelevant. And the fastest way to lose credibility, for example, is with that, hockey stick forecast or the classic line, if we capture 1% of the market. Sophisticated buyers have seen that 100 times before, and that's a surefire way to lose credibility.
Yeah, and probably what I would add to this is on the risk point. When we talk about risk, we're talking about buckets of risk. For example, there's product risk. When the company is at early stage, there's product risk, right? VCs are comfortable with product risk. In the context of M&A, it's rarely the case that someone will take on product risk, right? So that's for early stage businesses. Then there is execution risk. There's always execution risk. You cannot avoid it, right? But when you have a well-oiled go-to-market machine, when you have a proven track record of execution, and the company just needs to do more of the same, then that execution risk is reduced. And then, of course, there's financial risk, right? So if your company is not profitable, if it's cash burning, then you have the financial risk, you have default risk. And those are other risk buckets that buyers would need to assess. But those are the types of kind of risks and then there's legal and others, but that are being diligenced. But when we talk about risk, these are the kind of broad categories that buyers will view your business through.
So there are 4 things we see consistently in processes that kind of hold momentum. Number 1, the story is clear. Number 2, the metrics support the story. Number 3, that the stakeholders are aligned. Number 4, the preparation has happened before the buyers start asking difficult questions. None of that sounds particularly exciting, but there's a lot of value. But this is where a lot of value is protected. When buyers don't have a clear story, then they fill the gaps in themselves, and those gaps rarely, they're not going to be filled generously. Sometimes it's a junior analyst. Georgios gave this example yesterday. Sometimes it's someone in corp dev. Sometimes it could be someone in finance. But they take the information that they have, they make assumptions that might not be correct, and those assumptions start making their way into internal discussions. When that happens, you're no longer leading the narrative, you're reacting to it. So that's really the key message of this slide, is that if you don't frame the business properly, the buyer will frame it for you, and more often not, they'll frame it around risk. So yeah, go ahead, Georgios.
Yeah, and I think another element here that's very important is about first impressions, right? Everybody says you get one chance to make a first impression. So when you send a teaser, you're creating a first impression, and then when you share the IM, you have a second shot at a first impression, and then when you have the management presentation. But that all fills in the puzzle of the impression that the buyer has for you. And I think what Ilya alluded to is that if you don't take good care in filling out the puzzle for the buyer, then the buyer will do that for you. And there's 2 ways in which that can happen. One is the buyer thinks they know your business, but actually they don't have the full picture. And that's a very tricky place to be. Usually almost always how we will advise our clients would be to say, make sure that you stick to the narrative, make sure that you go through the script, even though the buyer may think they know your business, make sure you cover everything, because maybe they know your business, maybe they think they know it. So we always make sure that we control the narrative, we stick to the script so that we paint the full picture. That's one. The other way in which this can kind of backfire is the analyst example that Eli mentioned, right? The situation that were faced, for example, was an analyst on the buyer side was running some numbers. They were running an analysis on the financials, the churn rates, the retentions, and whatnot, and they were getting numbers that were not correct. Yeah, but there was nobody on the buyer side that was actually sanity checking those numbers. They were taking that the analysts analysis at face value, and if we hadn't picked that up, it would have been a problem because their investment committee would have assumed that that's the performance of the company. So what we did was actually we went to the analyst. We actually got access of his financial model and walk them through it to make sure that they get to the numbers that accurately reflect the business. Again, buyers are usually hesitant to share their analysis for a number of reasons. In this case, we actually managed to do it, and we caught that early on. But if we hadn't, then it would have been a problem. So that's just another example of how, if you don't control the narrative, if you don't shape it properly, the buyer will do that for you.
Thanks, Georgios. So let's break down each step. Take a closer look. Step one: crafting a credible equity story. So again, let's start with a misconception. Misconception is that the equity story is a marketing document. Try not to think of it that way. Try to think of it as an investment case for why someone should buy your business. Most founders naturally explain their company the way they run it. So they talk about the product, might talk about the customers and everything they've built over the years. Buyers are listening for something different. They're trying to understand whether this business is a business that they can confidently own, that they can grow, and that they can generate a return from. That's why every strong equity story answers these four questions. Number one, what problem are you solving, and why do the customers generally care? Number two, why is this market opportunity relevant today, and what's driving it? Number three, what makes the business difficult to replicate? And this is especially true today with the threat or the perception of threat of AI. And finally, why should this particular buyer care more than anyone else? So let's drill down a bit into that last question. The strongest equity stories aren't generic. They change depending on who's sitting across the table from you. A strategic buyer and a private equity investor may be looking at the same business, but they're often buying it for very different reasons. So if a narrative doesn't answer the questions that a specific buyer is asking, they'll start answering for themselves, and like Georgios said, filling in the gaps themselves. And that's rarely where you want the conversation to go.
And I think the other thing I would add here on the equity story, okay, you drafted, you're happy with the IM, you're happy with the equity story. That's not where the story. That's not where this ends, because you cannot assume that what you've put down in your IM will be fully absorbed and fully understood by the buyer. Yeah. So what you need to do is identify the areas that are more important than others, right? Crucial, and then make sure that you get those across. And you do that in a few different ways. One, repeat them. Right. Sometimes we get comments from the CEO or the management team that says, "Hey, we've already mentioned this here. Why are you repeating it?" And we're like, "It's by design." Right? Because you cannot assume that just because something is mentioned in paragraph 2 of page 34, that the buyer will pick up on it. Yeah. So we repeat it. Sometimes we repeat it 2 or 3 times on purpose to make sure that the message gets across. Secondly, we use the management presentation to reinforce the key messages. Right. So we don't just rely on the IM, but we also reinforce the key message through the equity story. We also get those messages across when we send separate analyses or when we have one-on-one questions. So it's a package, not a one document where you set it and you assume that everything will be absorbed.
So Georgios, we have a question. I'll read it out. How much of the story is generic versus buyer specific?
Great question. The The answer is it depends on the types of buyers that you are approaching. A lot of times you can reuse a lot of the pieces for, call it 80% of your target buyers, because more or less they're all interested in the same things, right? Now there's customization that happens, and usually that customization will happen maybe in 20% of the cases. We call it kind of a white glove approach, whereby for a subset of parties, we tailor the conversation. And we tailor the management presentation, we tailor some of the things that we highlight, right? It probably would not exclude things from the narrative for one buyer versus another, but maybe we would highlight different things. If you have financial buyers versus strategic buyers, there you need to tweak the part of the narrative that says, hey, as a standalone company, I'm able to achieve X, Y, Z. You change that, and then the context of a strategic, you talk about how you together with the strategic can achieve X, Y, Z. So that difference always applies to financial versus strategic. So overall, I would say 80% of the time you can probably reuse the vast majority of the narrative. And then in 20% of the situations, you tailor it for what we call kind of the tier one buyers or financial versus strategics.
Okay, yeah, I was just checking if there's another question. All right, fantastic. So yeah, let's continue. Crafting a credible story sounds straightforward, but you'd be surprised how often that narrative can miss. In practice, this is where we see a lot of founders lose buyers. So most founders explain their business, like I mentioned, like they'd explain it to a customer or an employee, and the acquirer isn't looking at it through that lens. They're asking a completely different question: why should we own this business? And everything really flows from that question. Can we grow it faster? Can we integrate it? Does it strengthen our existing platform? Will it generate an attractive return on the capital we're investing? That's why product features, a huge, total addressable market or a compelling founder story rarely carry the process on their own. They're interesting, but they don't answer the acquisition question. The strongest processes shift the conversation away from here's what we've built to here's why acquiring this business creates value for you. And that's a subtle difference, but it completely changes how buyers are evaluating the opportunity.
All right, I guess I can add here as well. And again, going back to the earlier question, so a strategic buyer will prioritize different parts of the narrative relative to a financial buyer. So a strategic buyer will always start with, does this acquisition align with my strategic goals? Right? Does the target company have the same ICP as I do? Does it accelerate my roadmap? Right? The strategic fit is the first thing that a strategic buyer will look at. If there's no strategic fit, everything else is irrelevant. Price is irrelevant. So that's what a strategic buyer will look at. Is there a geographical fit, for example? So then they will look at financials as a third element. A financial buyer looks at things slightly in a different order. The first thing they look at is the addressable market. Like the strategic will not necessarily worry about that because they're already in the market, right? So they know it, they're comfortable being in it. But the financial buyer has a choice to go into this market or go into another market. So the first thing that they will assess is the market opportunity, right? And is the timing right for them to go into this market now? So they start with that. So then they ask you questions about the market. Once they get comfortable with the market, then they'll say, is this company the right company for me to back in order to win in this market? Right? I like the market. Now I need to understand what horse am I betting on. So then they will assess your competitive advantage, your differentiation, your mode, right? And then they will decide whether to place their bet on you. And then as a third element, they look at your financials and everything. And then lastly, they will also look at exit options. Because a strategic, they will not look to exit or for another liquidity event 5 years from now. A financial buyer will also say, well, if I buy the company now, 5 years from now, how can I exit? Right? So they were all this, and so that's kind of the difference in sequence between a financial buyer and a strategic buyer, and yeah, it's important to keep that in mind. Also, linking back to the earlier question.
Excuse me. So one of my favorite parts of the process, other than closing, of course, is watching the shifts founders make when they start learning to speak the buyer's language. Like I mentioned earlier, founders naturally talk about the business through the lens of everything they've built, the product, the customers, the team, or the journey to get there, the founder hustle. Buyers hear exactly the same words, but they're translating them into something completely different. They're asking themselves things like, what does this tell me about the future cash flows? How risky is it? Can we scale it? Will this create value after we acquire it? That's why a good advisor spends so much time translating the founder's story into buyer language. So I'll give you a few examples. When a founder talks about a great product, the buyer is asking whether it's a sustainable competitive advantage, especially in this market when AI is perceived as such a threat. When a founder talks about loyal customers, the buyer is looking for evidence in the retention metrics. When a founder talks about working incredibly hard to win business, the buyer wants to know whether growth depends on the founder or whether there's a repeatable commercial engine behind it. And when a founder talks about vision for the future, the buyer is asking a much simpler question: can I underwrite that? Can I defend those assumptions to my investment committee? So that's the translation layer. The facts haven't changed, only the language presenting them has.
Yeah, and this is so interesting because, again, a very important part of what an experienced, advisor will bring to the table is to be able to read between the lines and explain to you guys and to your board what the buyer actually is asking when they're asking a particular question. And on the flip side, explain to you guys what an answer that you're giving may mean to the buyer. And you might think that it's straightforward, but a lot of times it's not, right? And saying the wrong thing, of course, you're not going to misrepresent reality, but a lot of times saying the wrong thing can jeopardize the transaction, or it can even jeopardize the valuation that you might be getting. So it's critically important to keep that in mind. I think the second element is that an experienced advisor who's done 100+ transactions or has spoken with 1,000 companies, they're able to bring context that the CEO, the founder who is who's focused on their own company, their own business, and their own kind of network of peers and competitors may not have. For example, when you brag about your retention or your growth or your product capabilities even, yeah, someone who's spoken with, a long list of other similar companies or a long list of investors may be able to tell you that, look, it's great that you perceive this as a strength. I would suggest wording it slightly differently because everybody's claim that says the same thing. Or focus maybe on this other thing because while you're proud about this one, and we will definitely mention this aspect of your business, investors and buyers really also care about this one. So we need to bring that up a bit higher in the narrative. So that context is crucial because otherwise you're going in blind, you're bragging about something that you think is special, whereas in reality everybody else is saying the same thing, and you're just not aware of it.
All right. So once you've established the story, you've got it right. The next question is whether the evidence supports it. Something that we've learned over the years is that buyers don't spend much time looking for proof that you're right. They spend their time looking for reasons that you might be wrong. That's why this step is so important. Every claim you make needs to be backed up by the data. If you tell buyers you've built highly efficient business, they'll look at your margins. If you talk about sticky revenue, they'll go straight to your retention and your cohort data. If you position yourself as an enterprise business, they'll want to understand contract values and life cycles. They're constantly testing whether the story, the metrics, and the forecast all point in the same direction. When they do, confidence builds, but when they don't, buyers start asking more questions. The more questions they have to ask, the more uncertainty creeps in. That starts to chip away at trust, and then uncertainty has a habit of finding its way into the valuation conversation.
And I think the other element I would add here is the consistency of the numbers. I think one of the worst things that can happen is for the numbers to change during the process. You show numbers to buyers, you show them a forecast, you show them, forget about historicals, right? The worst thing would be for your historicals to change. Because as Ili mentioned earlier, then they start to question a lot of the other numbers. So your historicals need to be clean, audited, fixed. Sounds straightforward. You'd be surprised how oftentimes that's not the case. And then secondly, your forecasts, right? A lot of times, one of the most common questions we get asked is, what should I project as a forecast? I would say, first of all, whatever you show, whatever you decide to go with, you need to stick with. You cannot keep moving your forecasts. So your forecasts need to be credible, reliable, presented to the board, approved by the board as a business plan for the year, and you go for it. Then the second element is the forecast need to be ambitious enough to get you the right valuation, but not overly ambitious that you end up missing them. And slightly conservative, so ideally you beat them by a little bit. That's the ideal situation. Now, how do you get to this? Again, it depends on a case-by-case basis. It's not easy. Forecasts are wrong by definition, right? So the moment you put them down, immediately you know they're wrong. But still, you need to make sure that they don't move from month to month. And ideally, you overachieve them by a bit. And then the third thing I will say is some founders, some CEOs ask us, okay, should I do X, Y, Z in preparation for a process? Should I cut costs to become more profitable? Should I be investing more in growth? What should I be doing in order for my numbers to look better for the buyers? And there's two answers to that. The first answer is you need to do what's right for the business. Don't do what you think buyers will want to see. If you do what's right for the business, that's probably the best approach. And then the second answer is don't try to embellish, right, your P&L and your balance sheet. Don't cut costs just to get short-term profitability. Why? Because buyers will diligence this, and again, we've seen this many times. They will diligence. Hey, you cut your dev team or you cut your XYZ team. Why did you do it? Right? Is this sustainable? Or is this a cost that I will need to build up again after I buy the business? What cost base am I buying? And some buyers will actually be upfront and say, did you do this just to make your numbers look better? Question, do we mean audited literally, like having a third-party audit financials, or just making sure they're accurate even if non-audited? That's a good question. Ideally, the numbers will be audited depending on the size of the company. Sometimes if the company is too small, okay, you don't have formal audits. Ideally, they would be, but above a certain size, the numbers need to be audited, and ideally, they would be audited by, a Big Four. But yeah, in any case, if you're too small and they're not formally audited, the company is small, that's okay. But certainly they need to be fixed, they need to be reviewed, the forecast need to be approved by the board, assuming you have these processes in place, and they shouldn't change from month to month. Okay.
Yep. All right. So everything we've talked about so far assumes the business is speaking with one voice. In practice, that's not always the case. You might have different co-founders that want different things. One founder might want to sell, another wants to wait. In one of my last deals, we had one co-founder that was single, one co-founder that had a family. The single person was happy to stay on for an earnout. The family person was less risk averse. One shareholder might be focused on valuation, another one cares more about retaining control or protecting the team. Buyers pick up on that surprisingly quickly. It might come out in a management presentation during diligence or just a simple conversation. But once buyers sense internal misalignment, they naturally become a lot more cautious. They start asking whether everyone is committed to the process, whether decisions actually can be made, and whether they'll end up negotiating with multiple agendas, for example. And they'll test you. That's why alignment before you launch is so important. Everyone should be clear on why you're exploring a transaction, what success looks like for everyone, what role you want after closing, and where the boundaries are before the first buyer conversation even takes place. You really only get one opportunity to make a first impression. I know it's an old cliche, but it's true. The absolute last thing you want is buyers spending time trying to understand the dynamics between the shareholders or the co-founders instead of focusing on the quality of the business.
Yeah, and in these situations, when it comes to kind of founder and shareholder objectives, again, I like to say that with your M&A advisor, you should be like with a healthcare professional. You need to be transparent, honest about what you really want, right? It's when you're designing a process, that then is not the time to hold back. If you want to move on, you need to tell us, right? If you want to stay on honestly, you need to tell us. If you want a minority transaction, you need to tell us. If you want a majority transaction, you need to tell us. Yeah, I was chatting with a founder the other day, and they had a great company. I think it was maybe 150 million revenue, bootstrapped, profitable, fantastic company. And we started the conversation along the lines of, hey, we're not looking to do anything. Maybe we want to buy a company. And then progressively, right, it started to come out, well, maybe we're going to raise a couple 100 million, and then from there it went, well, maybe also we would consider an exit. Like the starting point needs to be your objectives. And then once you settle on what you want to do, whether it's to raise a minority or to do a change of control, or you need to start with that, and then the process will be crafted around you. So that's super crucial.
So yes, on that point, stakeholder alignment only works if everyone is clear on what success actually looks like. So these conversations, we strongly encourage these conversations to be had with founders even before a buyer is contacted. And we need to establish: do you want a full exit? Do you want a partial sale? Or simply bring in a strategic partner? Is the priority taking as much cash off the table as possible, or are you happy to roll equity and participate in the next stage of growth? Would you consider an earnout if it increased the overall value of the deal? How long are you generally prepared to stay with the business after closing? So these aren't questions you want to be answering halfway through exclusivity. They influence the type of buyers you approach, the way the process is run, and ultimately the offers that come back. We've learned that founders often say they want the highest valuation, but actually, when you read in between the lines and you dig a little bit deeper, what they really want is certainty. Sometimes that means accepting a slightly lower headline price in exchange for more cash at closing, cleaner terms, higher probability of completing the transaction. So those trade-offs must be discussed before we ever enter conversations with the market.
Yeah, and I think the other thing to keep in mind is that incentives are not always the same. They're not always aligned amongst the different shareholders, right? That's the reality, right? Sometimes VCs or some shareholders have a different incentive than a founder. And so it can be as simple as liquidity preferences, minimum purchase price, deal structure, earn out or not earn out, current cash versus shares, go to market or not go to market. Yeah. For some VCs, if things are going great, you have a great company, things are going well, most VCs will say, keep going, keep going, keep going. For the founder, it could be a different story, right? A founder might say, well, I'm tired, or I feel in my gut that things will turn or competition will become tougher. I want to explore my VCs, they want me to keep going. So it's a delicate balance. But these are all issues that need to be navigated, and a lot of times we're able to share some perspectives on how to even navigate these types of misalignments.
So I'm actually just going to read this sentence straight off the side because I think it sums it up perfectly. Founders only start preparing once inbound interest arrives, are usually already on the back foot. By then, the process is running on the buyer's timetable, not theirs, and they've already given up the leverage. That's exactly what we see. Preparation is one of the few things in M&A that's entirely under the seller's control. Once buyers are involved, you're responding to requests, managing deadlines, and then making decisions under pressure. The best processes feel controlled because the important decisions have already been made. One mistake we see quite regularly is founders assuming that one interested party is enough, and it really isn't. We have a saying that one buyer is no buyer. Until you've tested the market, you don't really know whether you found the best buyer, the best structure, or the best valuation. And you have to remember that as a CEO or founder, it's your fiduciary responsibility to make sure that you calibrate the market and not just take the first offer that is presented to you. Running a structured process creates that optionality, and options create leverage. That doesn't mean approach an infinite list of buyers. They have to be sophisticated buyers. They have to be qualified buyers. And they have to be sequenced properly, keeping competitive tension alive, making sure that no single buyer gets too far ahead before the market has had the chance to respond. That's how sellers stay in control of a process rather than reacting to it.
Yeah. And the other I think scenario here is what happens when there's inbound interest. I think probably at least 80% of the time, a company will have had inbound interest. And it's always interesting to hear that people think they're unique in that way, right? Oh, we have this relationship, or we were approached and we're having these conversations. Practically every company out there has had these inbound interests. Sometimes it's real, most of the time it's superficial. I think the way to manage that is twofold. For the one, as Eli mentioned, it's rarely a good idea to start entertaining these on an ad hoc basis, right? We've seen founders who've been having conversations with interested parties for months and quarters and years even, with nothing actually happening. And why is there nothing happening? Well, it could be a number of reasons, but most of the time, the buyers are just not serious. They see no time pressure, they see no deadlines, they see no formal process. And maybe they're just window shopping, maybe they're not sure. So rarely, but then the founders spend time entertaining this conversation, then it's to some extent it's okay to maintain a relationship, but that's not what gets you the deal, the proper deal. And the second thing is that once a process starts formally, properly, then two things happen. Window shoppers fall away, right? So the parties that are not serious are asked to actually, make a decision. Are you interested or not by this deadline? And if they're not interested, then they'll fall away. And then the truly interested parties will step up, right? And they will submit a bid. So you get the clarity that you've been missing for months and quarters and even years. And then the last thing I'll say is that, interestingly enough, a lot of the time, the party that approached you or, was shopping around and this and that, a lot of the time, if not most of the time, they end up not being the ultimate acquirer. And I remember in one scenario, there was a company that ran a process bilaterally. They did the transaction, and then we were chatting with another buyer, and they're like, "Yeah, did you see the transaction? They did it bilaterally. They didn't have a process. We would have loved to bid for that business. We were really this is exactly what we're looking for." And so it's just a lot of different things to take into account when managing this inbound interest.
All right, so we've spent the first part of today's session talking about theory and some examples of live cases with buyer engagement. So let's change gears and look at things a little bit more practically. One of the most important tools in the sell side process is the information memorandum, or IM, or confidential information memorandums, or SIM. But essentially, a good IM is an opportunity to shape how sophisticated buyers understand the business. Everything we've discussed today comes together here. The equity story, the evidence behind it, the way the business is positioned, and the investment case you're asking buyers to believe. So as we go through this example, don't think about it as a template for writing a document. Think about it as a framework for communicating with buyers. Every page should answer a question. It should reduce uncertainty, and it should build conviction. And that's exactly what we're going to walk through now. But before we get into the IM itself, I think it's worth remembering that no single document sells a company, and no single moment sells a company. The teaser isn't there to close a deal. It's there to secure an NDA. The IM isn't there to get an offer. It's there to earn a management presentation. And the management presentation builds conviction ahead of an LOI. And the LOI itself earns the right to begin diligence. Every stage exists to move the buyer confidently to the next stage of the process. So if you try to answer every question too early, or you try to boil the ocean, as we say, you overwhelm buyers. And if you answer too few, or you don't provide enough information, then they lose interest. So good process design is about giving buyers exactly what they need when they need it. All right, so these are a couple of pages that have been, the next few examples are actual IMs. We've obviously redacted them for confidentiality reasons. And this is the executive summary. So after the cover page, this is the first page that buyers see. This is probably the single most important page in the entire IM. Think about the position the buyer's in. They've received dozens of opportunities throughout the week. They don't have time to read every page of every single IM in detail. They're trying to make a very quick decision about whether this business deserves their attention. So this page has one objective: to answer the question, why should I spend my time looking at this opportunity? We sometimes refer this to the armor-piercing page because it's designed to cut through the noise and immediately answer the questions every sophisticated buyer is asking. And those questions are: is this business growing? Is it profitable? Do customers stay? Do existing customers spend more over time? Is there a genuine product moat? Is there evidence that customers are getting real value from the platform? So within a couple of minutes, and maybe even just a few seconds, the buyer should already have a very clear picture of the quality of the business and why it's worth investigating further. And another thing to notice is we're not trying to sell the whole story on one page. We're giving buyers just enough evidence to say, you know what, this is interesting, and I'd like to understand more. I want to lean in. And that's exactly what a strong executive summary should do. So it earns you the right to take the buyer through the rest of the investment case.
Yeah, and of course, this is very different for different companies. Yeah, so you bring forward what you consider to be the strengths, and yeah, whether it's the growth rate, whether it's retention, whether it's the geographical presence, the technology, it varies from company to company, but it needs to be digestible within seconds by whoever is looking at the page.
This is another section that sophisticated buyers go to very early in the process. They're trying to answer a question here, which is: how resilient is the revenue base? Customer concentration is really a proxy for risk. If one customer represents 30 or 40% of revenue, buyers immediately start asking what happens if that customer leaves. And that uncertainty almost always finds its way into the valuation, and sometimes even walking away from a deal. In this case, in the case of customer concentration. So what we're trying to demonstrate here is the opposite. No single in this particular business, no single customer dominates the business. The top 10 customers account for less than a quarter of the ARR, and around 70% of revenue sits outside the top 20 customers. So what that tells the buyer is that the business isn't dependent on one relationship or one contract. Revenue is diversified across a broad customer base, making it more predictable and more resilient. And again, please notice we're not just presenting the data, we're answering the buyer's questions before they have to ask it. So by the time they finish reading this page, they should already understand that the concentration profile of the business isn't a risk, and that they have that they have confidence that customer concentration isn't likely to become a major diligence issue. So by this stage of the IM, we've established that the business is growing, customers are staying, the financial profile is attractive. The next questions buyers are likely to ask is, does the product actually deliver meaningful outcomes? Notice these aren't product features that we've listed here, they're commercial outcomes. Hours saved, employees reached, countries supported, processes automated, speed of deployment. These are the metrics buyers remember because they're the metrics customers buy. So when a strategic acquirer looks at this page, they're already thinking about how those outcomes translate into a stronger customer retention, pricing power, competitive differentiation, or for example, reducing their roadmap for go-to-market or product launches. For a financial buyer, the thinking is slightly different. They're asking whether these customer outcomes create a durable competitive advantage that can support future growth. And again, the objective isn't to impress buyers with numbers, it's to reduce the uncertainty and build credibility. If buyers can clearly see the value that the customers receive from the platform, they have to spend less time wondering whether the product generally solves an important problem. So every page in the IM should answer another buyer question. And so that, in summary, this page answers, does the business create meaningful value for its customers? And once the buyers believe that, it's much easier for them to believe that the revenue can continue growing post-acquisition. So so one of the biggest mistakes founders make is assuming that the numbers speak for themselves. They don't. Metrics always need context. This is a company that was doing extremely well and then had headline retention deterioration. And if we simply presented that number without explanation, buyers would naturally assume that the structural churn was a problem within the business. Excuse me. But once we dug into the data and we recut it, we found something very different. Two enterprise customers that had been with the business for almost a decade each had outgrown the platform and moved to a global end-to-end solution. Together, they represented about 12% of the revenue base, so the departure had a disproportionate impact on the headline retention metrics. And that's a very important distinction. This wasn't a business losing customers because the product wasn't working. These were long-standing customers that had become too large for the solution, and there was a change in strategy at the global level. So when we recast the analysis to show the numbers, we wanted to show buyers that the underlying business. We wanted to show them what the underlying business looked like without these two, let's say, outlier events. So now all of a sudden, the retention profile looked much more like what you'd expect from a healthy SMB-focused SaaS business, and just as importantly, the exercise highlighted another opportunity to scale into adjacent markets. So this is an example of what a good advisor should be doing, not trying to hide the facts, not trying to manipulate the numbers. We're simply providing the context that allows buyers to underwrite the business based on underlying commercial reality rather than a headline metric in isolation.
Yeah, and this is important because essentially what happens here is the advisor or we identify an issue, like the company may or may not have figured out that this can be turned into an advantage. But we identify an issue, we try to turn it into an advantage by recasting the numbers. But then that's not where we stop, right? We don't stop at including a slide in the IM, because we know from experience that this could become a major issue. We proactively bring this up and we position this during the manager presentation, during one-on-one conversations with the buyers, during separate analysis that we share with them. So we're able to identify what would become major issues, try to mitigate them or recast them, and then make sure that we repeatedly get these across to ensure that the message is heard by the buyer loud and clear.
So closing thoughts, let's pull the key themes together before we open up to Q&A. We've covered a lot today, but if you remember three things, remember these. First, buyers buy businesses that they understand, that they believe in, and that they can confidently underwrite. Second, every claim that you make needs to be supported by evidence. The narrative, the metrics, the roadmap all need to reinforce one another and be interconnected. If they don't, buyers start filling the gaps themselves, and they do that by usually underwriting risk. And finally, preparation is where the leverage is built. By the time you're negotiating with buyers, most of the important work should have been already done. Everything that we've discussed today is really about the one objective, which is reducing uncertainty and building buyer conviction before the first offer is ever made. So the obvious question is, how do you actually put all of this together into practice? And that's where experienced advisors add the most value. Which leads us into what founders get from advisor-led process. A good advisor does more than introduce buyers. The real value comes from bringing structure, judgment, experience to a process that most founders only go through once, and what could be one of the most important transactions of their lives. It starts with making sure the business is ready before buyers are introduced, and then from there it's about shaping the narrative, approaching the buyers in the right way, controlling the sequencing, and maintaining competitive tension throughout the process. And then as the deal progresses, the roles change again. Buyers test assumptions, new issues might emerge, emotions inevitably come into play, and commercial decisions become more difficult as the finish line gets closer. And that's where experience really matters. We've seen enough transactions to know, which issues are material, what are negotiating tactics, which simply need to be, what issues need to be managed without losing momentum. So having someone by your side who's been through it before, during these negotiations, specifically closing price adjustments, which can be very stressful, that can easily justify the success fee in one simple decision. And then finally, an advisor sends a really strong message to the market. Buyers know they're entering a structured process. They know that you've invested in this process, and you've invested in an outcome. They assume there'll be competition, and they understand that they'll be dealing with experienced professionals who know how these transactions should be run. And for founders, that means less distraction. You can stay focused on your business, keep your eye on the ball. It means better decision making and a much greater chance of achieving the right outcome.
Yeah, I think this is great. And in closing thoughts, I mean, remember, M&A, it's not formulaic, right? There's no formula that says, A plus B equals C. These are my numbers, da, da, da. This is the outcome. This is what, you should be paying. It's not formulaic. It's not science, it's not math. It's more of an art, right? It's a people business. It's a conversation with a number of parties. Emotions get involved. We had one situation where during due diligence, the management team got so frustrated with the buyer that they were like, oh, we cannot work with these people. We need to stop talking to them. Let's walk away. Let's talk. And then then at the end of the transaction, they actually thanked us for making sure that the calmer heads prevail, because we were able to bring the context into the conversation and say, look, what is happening here is not a clash that deserves the transaction to fall apart. We just need to take a breath, and just do X, Y, Z. So a good financial M&A advisor brings a lot to the table. The company remember when we said, when you go into exclusivity, the negotiating power shifts from the seller to the buyer, right? But then that's a point where the buyer might try to retrade. And that's where, again, a financial advisor can handle the situation properly. And we've done this, several occasions whereby retrading didn't happen when could have happened, and the client ended up saving millions just through that, just by avoiding a retrade. But if you say the wrong thing, if you are not firm enough where you need to be firm, or if you're too firm on things that don't matter, if you're not able to judge what matters, what doesn't, if you get too eager, too excited, there's so much happening. And again, a good advisor is able to provide kind of the experience, the context, and a steady hand through to a successful closing.
Yep. So I think, just to wrap up very quickly, you can appreciate that the best exits aren't accidents. They're the result of deliberate preparation and disciplined execution. And in our experience, the companies that achieve the best outcomes are the ones that treat readiness as a business discipline, as part of their operating model, even before they decide to go to market. Better documentation, team structure, all create more options. They improve buyer confidence, they reduce the dependency on a founder, and they reduce value leakage in the final stages of a process. Remember, you don't need to force a transaction, but for sure, don't wait until the last second to prepare. All right, so that brings us to the close of the webinar. This is the second of a 6-part series. Tomorrow, we're going to talk about valuation maximization drivers, how buyers think about valuing a business, how they think about premiums, what issues might discount valuations, and we'll do a case study. We'll run a few examples. Yep. So I think we'll share this deck with you. We'll share the recording. But if anybody has any questions, happy to answer now, or happy to have a offline conversation, if that is your preference. So for a company that is not yet profitable and still burning cash, how differently does the equity story need to be built compared to a profitable business?
So a couple of things. Profitability doesn't necessarily change the narrative. Profitability really affects the buyer universe. So if a company is burning cash, some buyers just may simply not be interested. So I wouldn't say that the equity story changes as much as the buyer universe shrinks a bit. Now, you may need to explain your path to profitability in the near term, because a buyer who acquires the business may view the future losses as a liability, and they may discount them from the price. So, the one thing that you probably would want to add is, okay, how can the company on a standalone basis become profitable? What would it take for that to happen? Of course, if you're talking about combining with a strategic, then there's synergies, so that path to profitability may accelerate. But certainly you'll get asked the question of on a standalone basis, what would it take for the company to get to break even?
All right. Thank you everyone for attending. We appreciate it. We really do appreciate your time. And if you have any questions, drop us a line later or offline, and we will share the recording and the PDF, like I mentioned. Thank you very much, and have a good evening.
Thank you, everyone.
Thank you.